Hey there, welcome back to Fibonacci's Traders. Today's topic, semiconductor stocks overall bearish outlook. Semiconductor stocks are making headlines again, but not for the reasons we'd hope. Why is this happening, and what does it mean for long-term investors? In this video, we're diving deep into two significant bearish factors impacting the semiconductor market and one bullish catalyst that investors may be underestimating. Whether you're already invested in semiconductors or just watching from the sidelines, this is a conversation you won't want to miss. Let's begin with the bearish forces shaking up the semiconductor industry. First up, macroeconomic uncertainty. Earlier today, the latest U.S. job report came out, and while strong job numbers are good news for the economy, they've created fresh worries on Wall Street. Why? Better than expected economic data has sparked fears that the Federal Reserve may not ease interest rates as soon as investors hoped. Some analysts are even suggesting that rates could rise again, a scenario that would tighten liquidity and increase borrowing costs across the board. Now, why does this matter for semiconductors? High-growth sectors like semiconductors are particularly sensitive to interest rates because their valuations are often tied to future earnings. When rates are high, the value of those future earnings decreases, creating downward pressure on stock prices. So while Nvidia and AMD are fundamentally strong, the broader economic environment is adding a layer of uncertainty that's hard to ignore. Now onto the second bearish factor, geopolitical and regulatory risks. Nvidia in particular has been navigating a complex regulatory landscape. Earlier this week, reports surfaced that the Biden administration is considering additional export restrictions on AI chips. For context, Nvidia is already prohibited from selling certain high-end AI chips to China and Russia due to national security concerns. These new restrictions could potentially widen the scope of what Nvidia and other chip makers are allowed to sell abroad. Nvidia's Vice President of Government Affairs recently commented on the issue, arguing that these restrictions might not achieve their intended security goals. Instead, they could push international markets to adopt non-US technologies, ultimately undermining America's leadership in the AI space. And let's not forget the looming administrative transition. The incoming Trump administration could either double down on these restrictions or pivot toward deregulation, which might benefit the semiconductor industry. This political uncertainty adds yet another layer of volatility to an already complex market. As an investor, the key takeaway here is to expect the unexpected. The semiconductor sector is inherently volatile because it sits at the intersection of cutting-edge technology and global politics. Whether it's trade restrictions, export bans, or new incentives, these factors can swing sentiment rapidly in either direction. Let's shift gears and talk about the bullish news that many investors might be overlooking: TSMC's December numbers. For those unfamiliar, TSMC is the world's leading semiconductor foundry, manufacturing chips for companies like Nvidia, AMD, and Apple. Their December results were nothing short of spectacular. Revenue grew 57.8% year over year, and for the full year, revenue surged 34%. Now, why does this matter? TSMC's performance serves as a barometer for the entire semiconductor industry. Their strong numbers indicate robust demand across multiple sectors, from AI to consumer electronics. The chips TSMC is producing now will eventually power laptops, smartphones, and gaming consoles, meaning we could see a ripple effect of positive growth in the coming quarters. For Nvidia and AMD, this is a particularly encouraging sign. Both companies rely on TSMC's advanced manufacturing capabilities to produce their cutting-edge GPUs and CPUs. Increased demand for consumer electronics suggests that Nvidia's RTX GPUs and AMD's Ryzen processors could see a surge in adoption, particularly as we move further into 2025. But it doesn't stop there. This growth isn't just limited to AI or high-performance computing. It extends to other areas like memory products, which are integral to every device that uses a semiconductor chip. Companies like Micron Technology, which produce DRAM and NAND memory, stand to benefit as well. TSMC's numbers are a reminder that the semiconductor supply chain is interconnected, and strong performance at one node often signals broader industry health. So, where does this leave us as semiconductor investors? On one hand, we're grappling with macroeconomic headwinds and geopolitical risks. On the other, we're seeing undeniable signs of strength from key players like TSMC. For Nvidia and AMD, the story remains compelling. Nvidia's dominance in AI and data centers positions it well for long-term growth, even if export restrictions create short-term hurdles. Meanwhile, AMD's diversified portfolio, spanning CPUs, GPUs, and AI accelerators, gives it a robust foundation to weather economic fluctuations and emerge stronger on the other side. The challenge and the opportunity lies in navigating the volatility. As an investor, it's crucial to separate short-term noise from long-term trends. Focus on companies that are innovating, expanding their market share, and delivering strong financial performance. Nvidia and AMD check all these boxes, making them strong candidates for any long-term portfolio. To wrap up, the semiconductor market is facing a mix of challenges and opportunities. Yes, macroeconomic and geopolitical factors are creating headwinds, but the underlying demand for semiconductors remains robust. Nvidia, AMD, and even TSMC are at the forefront of this revolution, driving innovation in AI, gaming, and consumer tech. So, what's your take? Are you holding on to Nvidia and AMD through the volatility, or are you considering adding more to your portfolio? Let me know in the comments below. And don't forget to like, subscribe, and check out the links below. Thanks for tuning in, and I'll see you in the next one.